Investing in United States treasuries, it's a very hot topic these days, and that's what we're going to talk about, what they are and how to take advantage of them and why. Let's first define what a treasury is. So treasuries, they are instruments that are created by the United States government, and it works the following way. Basically, government is borrowing from individuals or from countries sometimes or from organizations. They're saying, here, give us an X amount of money, we will pay you back with interest. That interest varies. It could be 1%, 4%, 7%. Today, that interest is very favorable. Suppose you invest $1,000 with the government. The government is borrowing $1,000 from you, and they're saying it's for 1 year. And there are various durations of that contract I will mention very shortly. But let's say you're investing with them for 1 year, $1,000, and they're paying you 5%. So at the end of the year, you're going to get a check for $1,050. You see, you put 1,000 at the end of the year at this 5% yield, you will get $1,050. If you put 10,000, you're going to get 10,500. For any gain in the United States, so this $50 that you made on $1,000, you have to pay income tax. You put in a sum and you get a bigger amount. Now, why is this lucrative? This is lucrative because this is backed by the strength of the United States government. Now, these are very, very safe investments. They never failed. We don't expect them to fail. As long as we have our strong economy, our strong military, we obviously have a lot of trust in the United States. The government is the one who is paying interest on this. Now, suppose you only want to invest for 6 months, or vice versa. You want to invest for a longer period of time, for 10 years or 30 years. Those instruments also exist. By the way, the period of time, whether it's 6 months, 1 year, 2 years, is called the maturity. Basically, if you say, okay, I bought a treasury with a 2-year maturity, means that you have a 2-year contract. So interest that they were paying, the yields, they're called yields, the interest that they're paying on these instruments about a year ago were all about 1-2%, sometimes less, sometimes between 0 to 1%. Yield for 2 years, 1 year, or 6 months are around 5%. So imagine you put money with the government. Let's just say you can invest $50,000, and you put it for 2 years, and each year they pay almost 5%. So you'll get $2,500 first year and a little bit more than $2,500 the second year, because the interest is compounded. Now for the second year they will pay you interest already on $52,500. So, but let's just round it and say that you're going to get back $55,000. You put in 50, each year you get 5%, which is about $2,500. You're going to get back $5,500. Normally, on any gain, Americans pay what's called gain tax or capital gain tax based on whatever money you actually made. So you invested 50, you got back 55 in this example, you have to pay tax on this 5,000. But what happens, this money is exempt from a state and local tax. You will only pay the federal income tax. So that's another saving. Look how many advantages. The rate that they're paying is pretty good, 5%. It's guaranteed, and you don't pay taxes on state or local taxes. Let's consider another example. Let's say 6 months pays 5%, and then 1 year pays 4.9%. What to do? Should you just freeze your money for 1 year at 4.9%, or should you do 6 months and another 6 months at the end of it if you decide? So obviously the choice is yours. Here's what happens. If you go with a 6 months contract at 5%, you do not know what the rates will be in 6 months. They may plummet and go down or go up. So you may win or lose. Here for 1 year, you guaranteed your 4.9%. By the way, the yields that I'm giving you are very, very close to what they're now. Because it's a guarantee, because these treasuries are competing with regular investments in stocks. You know, people working in big corporations that actually in this what they call brokerage houses that manage money for people, they actually notice that a lot of people are moving into these treasuries and they're putting their money there instead of buying stocks. Now, obviously, people are still buying stocks, etc., but this became a big competition. My next discussion about this is why this is all happening. Why did we have yields on these instruments around 1% a year and a half ago, and now they're about 5%? This all has to do, obviously, with the inflation, with the fact that the government is raising rates, and this is how they entice people to invest with the government. I want to turn up my discussion and talk to you about how these bonds work. So basically, bonds, there is a price that people pay, and then there is a yield. I discussed earlier, let's just take a 1-year security, is about 5%. You see, however, yields and the price that people pay for it have the inverse relationship. The higher the yield, the lower the price. Okay? So they pay less to get to this point. Another aspect of this, how can everyone buy these securities? So the government, they have auctions. At these auctions, they sell it. They can announce the auction and say, okay, today we will be selling 2-year maturities, and this is going to be the amount, okay, based on today's yields. Now, important thing to remember, anytime people would like to buy bonds, there's two components, price and yield. Yield I just described, it's about, let's say for a 1-year security, about 5%. But then there is a price. You see, the price and yield have inverse relationship between themselves. The higher the yield, the lower the price. For example, if that 5% becomes 6, the price to buy for consumers or for institutions will go even farther down. So what will happen eventually? Interest will be so much if the prices are low. People will start buying these securities in bulk. And when I say people, I mean not just individual people, I mean organizations, even countries. And you know what happens by the law of supply and demand. Once the demand is high for these lower priced securities, the price will go up. When the price goes up, remember I told you they have inverse relationship. The yield will go down. And when the yield goes down, the interest rates in the economy will also go down. Once the inflation is also in check, I've been saying this many times, so on these securities will also go down. Why am I saying all of this to you? If you'd like to take advantage and look into this and buy the United States Treasuries, now might be a good time. Write to us in comments. I know this topic could be a little bit confusing and complex. We would love to hear your feedback. Subscribe to our channel. Until the next time, God bless you all. Thank you.